welcome to Thank God It's Friday. We're being joined by Kenneth Andrade, the founder and CIO at Old Bridge Capital. Welcome back, Kenneth. The last time that we spoke, the demonetization bomb had just hit us and had led to a sell-off in the markets, and here we are today, markets continuing to make newer highs.
Yep. So we're going to talk about GST this time, right?
Right.
Yeah.
So, in fact, that's what I wanted to come to you on. Back in November, you had said that it would take at least a year and a half for some sort of stability to return post demonetization. And while demonetization was an event that did take markets by surprise, earnings hit owing to GST has been widely anticipated. Do you really think that markets will sort of overlook any negative hits that easily and just move on?
Well, markets have been overlooking a lot of negatives for some time right now. Okay, so basically, if you take the last 5 years of earnings growth has been extremely tepid. But yet the multiples in the entire markets have actually expanded themselves. So to an extent, all the bad news is getting digested, and markets tend to find the way higher. Of course, a lot of that has got to do with the way alternative investment opportunities are decreasing, and liquidity en masse is coming to the equity asset class. So I think that's where the argument has been. A flood of liquidity. Domestic markets are attracting significant amount of that number, and you've got price earning multiples where we are. So if demonetization hasn't impacted growth, or growth has not gone negative, you might struggle for a month or two this time with GST, and then you'll be back to normal. But it's very difficult, and like we know from the last 6 months to now, predictability is extremely low. So I anticipate a slowdown for a month or two, but we never know how that works.
Do you really believe there are any pockets where we could actually see a positive surprise in terms of earnings, given the GST impact?
Well, one of the large trades that have been talked about is a transfer of market shares from the informal unorganized business to the organized business. You should see a disproportionate amount of that coming through in commodity businesses, where you have a lot of MSMEs or small scale sectors as they struggle to deal with compliance. Okay, so a lot of these companies may not grow capacities to address the market in the near term. And that's the opportunity that's left for the organized business. So I guess that's one segment of the market which you will see fairly high growth in volumes, and when you see growth in volumes relatively higher than the industry growth, you will also see profitability surpassing its historical trends.
We understand that you are interested in some of the media stocks. Some of the names I was going through included Jagran Prakashan, DB Corp, and TV Today. I also know that while some of them are fundamentally very sound, in terms of returns, well, it hasn't really been substantial over the past few years. What is it that is appealing to you when it comes to some of these counters? And I understand you can't talk specifically about these stocks, but as a theme, what is it that appeals to you here?
Well, media as a segment has been impacted in the near term. Okay, so you look at it in the last quarter, the quarter after that, the quarter now. It's been impacted by one reasonable amount of investments in one part of the bouquet. Second, you've got events that have in the near term actually collapsed the size of the industry. Okay, so they're struggling with growth. Okay, but existing businesses or existing numbers they've been able to maintain. So that's what we're paying for, maintaining existing set of numbers. So the challenge with that part of the world is expectation levels are high, but the delivery is, because of macro factors, is not as in line with even our expectations.
Right.
In the long term, yes, media spends have to improve. If you are in an expanding economy, obviously the product has to get to the end consumer, and a lot of these companies just act as bridges between the end consumer and manufacturer.
Right.
Fair enough. Kenneth, I know that a significant portion of your portfolio, or thematic portfolio at least, comprises of agri-related stocks, and I'm guessing that you must have been very happy when farm loan waivers were announced.
Well, it's a moral hazard. Okay, but we just look at it from a from a small mathematical equation. Okay, farm loan waivers till date has been about 95,000 crores. This is in 5 states, which have been announced. The next round would be in another 13 states, if I'm mistaken. Yeah, about 13 states, which is in the process. I'm not saying that they'll happen on there. And that number would be close to about another 1,30,000 crores.
Wow.
So you're looking at it from a perspective of 2,20,000 crores to 2,30,000 crores of farm loan waivers over probably the next 3 years. Okay, now what does these numbers do? These numbers effectively strengthen the balance sheet of the person who receives these numbers. And if you strengthen the balance sheet of a person who gets this kind of who gets a liability written off, if the balance sheet improves, you can create an income. Okay, so that's our underlying logic to the farm loan waivers. How it gets implemented, does it get implemented, are still question marks whether it will happen or not. But from our perspective, 2,20,000 crores, if that's going to be a number, is close to 15% of your farm GDP. Okay, so your crop GDP or your farm GDP is about 15 lakh crores. So it's like stimulating that economy by almost 15%.
Right.
Okay, and that's what's reasonably attractive. The quantum of capital, which could be available into the next 2-3 years, into the next 2 cycles, is significantly large, and we are interested in that.
Okay, but the rural sector is also the one which actually took the biggest hit from demonetization, and I understand that over the last 6-7 months the situation has improved, but what of our conversations with analysts, what we've been understanding is that the complete impact of demonetization hasn't really been absorbed as far as the rural economy is concerned. Plus, the rural or agri-input companies are heavily dependent on monsoons. I mean, aren't these two very big risk factors for that theme?
I mean, these businesses are cyclical; they're never secular
Right.
in any which ways. And what we like about companies in that business is they're consolidated. So if you look for number 1, number 2, number 3, they'll exist. Number 4, 5, 6 are very distant 4, 5, 6.
Correct.
So if capital or the cash flow in that cycle expands itself, and this is led by the government initiative, okay, the net beneficiaries are companies that are catered to that market. Okay, so I mean, it sounds a little simplistic. It may not be that simplistic, but if these companies are existing on the ground, this capital is put to right use in terms of productivity. The companies that are residual on the market actually absorb significant amount of money. Now, whether demonetization impact has played out, not played out, I think we will know as we go through the next 6 months to the next 18 months of execution of this cycle.
Right. But Kenneth, if you're so bullish as far as the agri and rural themes are concerned, I mean, why not also play the NBFC theme? Because if you talk about say microfinance companies, or you talk about some of your NBFCs like a Mahindra and Mahindra Financial Services, which are serving the rural markets, I mean, the end point customer is ultimately the same, whether the farmer or somebody who is doing agriculture allied activities. So, I mean, should we assume that you're also equally interested in some of these NBFC names, microfinance names, or even a housing finance company for that?
So there I can't grapple with. One is credit cost, and second is valuations.
Valuations.
Yes.
Okay, so one is I don't mind the businesses if the credit costs are low, and then you are willing to pay a certain amount of I would say premium, but a certain amount of value for these guys. But when you have high valuations and there's a question mark around credit costs, it's a risk that I can't. I mean, we can't comprehend that kind of risk. So we sidestep that. You play the liability side, or you play the asset side. I mean, you play one of them. I think we prefer more the companies that cater to the liquidity in the system, rather than companies that provide the liquidity in the system.
Right. You know, speaking of agriculture, you're also interested in sugar, and we know that a lot of these sugar stocks have seen a stellar run over the past couple of years, but mostly because of the fact that we've seen an improvement in sugar prices. Your interest in sugar, does it have to do with sugar prices, or do fundamentals also have a very, very big role here?
So if we are at the top of the cycle, as far as that commodity is concerned, I'm there with no financial risk on the balance sheet. When I mean no financial risk, all these companies are debt free.
Right.
Okay, so even if sugar prices go flat and sugar as a commodity doesn't make money, there are all allied business streams that these companies have, but they still be cash flow positive.
Right.
Okay, so even at earnings which are scraping the bottom of the barrel historically, they're pretty okay. So I'm playing cash flow, solvent balance sheets, and at a reasonable value. What is missing from the entire equation is growth. But I find it very difficult to predict growth in a lot of businesses.
Right. Right. Okay. So then I'm going to come out of agriculture. I'm going to go to information technology. Are you of the opinion that relatively smaller IT companies have more flexibility in when it comes to changing in demand environment, considering the kind of changes we are seeing from clients and what they want from the industry?
So small companies do have the flexibility. One is because of the small base. Second is they adapt well to a changing environment. Large companies usually take time to turn the tide. But if a small opportunity gets large, the larger companies actually benefit from a lot of that. So I think that you'll have to mix and match you'll have to mix and balance those two statements to see whether a large company is good because of the cash flows it's generating and in the verticals that are doing well, or we'll have to look at the smaller companies on a smaller base, how rapidly they're growing, and can they scale it to make it a reasonably sized opportunity for themselves.
Okay, so you would deal with a specific company. You'll go from company to company and not necessarily a mid-cap company as against a large-cap company.
Yeah, I think we'll keep capitalizations out of it. We'll look more at execution.
All right.
Kenneth, from an investment perspective or framework, your advice has been to avoid everything which is expensive, and that is on your company's website. Is there anything which you believe is not expensive? Or let me put it the other way around, apart from your agri and rural plays, what is it that you like?
No, even they are expensive. I mean, frankly, in this market, whatever value doesn't exist. Okay, and pricing of an asset continues to tear up. Of every asset continues to tear up. So I can't say that there are pockets of opportunity that will do well, but very clearly the market is paying you for execution. Okay, now how much are you willing to pay for execution is something that you need to be comfortable with. Okay, the place that we are investing in, it's a very small part of the overall economy, but it probably addresses a very large part of the population.
Right.
Okay, so by GDP metrics, we're probably in a very tiny part of the Indian economy. So that's essentially where we are at. But if you ask me purely from a valuation perspective, I think we've seen valuations at this place before higher than this. We'll have to wait and watch how it goes.
So where does an investor put incremental money then?
So you just have to maintain. I mean, I think investing is all about discipline, and you have to maintain that discipline of asset allocation, especially in these times.
Fair enough.
Yeah.
All right. Thank you very much for your time, Kenneth. A very under-owned sector, I would believe, is what you're really betting on. Let's see how that plays out. But that brings us to an end to this edition. Thank you for watching.